If you're a multifamily investor and use a lot of CMHC products, know that this recent policy change just made your loan that much more expensive. Stay tuned for this video where Josh and I break down the most recent policy changes.
What is going on, guys? It is Josh and Aaron back for another Finance Friday, and boy, do we have something new for you. We have another CMHC change. Thank goodness they actually continue to make these changes so we know what to shoot content for you guys, but they made some changes and it's pretty impactful, so we're going to get into exactly what they did, how it affects you, and how it's going to affect the market moving forward.
Yeah, so this time around, they have decided to go and change the insurance premium. So under the previous policies, MLI Select and the MLI market, or what is like more commonly known as just like the CMHC Standard program, they each had their own separate base levels of premiums. The MLI Select had, it was almost half, like it was significantly cheaper than what you were getting on the standards. That combined with crazy high loan to cost, loan to values was just creating a lot of stir around the MLI Select program, and it made for a really good product offering. With the changes now, what CMHC has done is they've actually taken the base premiums for both the standard product and the MLI Select product, and they've essentially made them the same base premium now. And then they've also added a third category for construction specific premiums. So previously, again, like if you were doing a new construction, it was just going to fall under whatever program you qualified, CMHC Standard or MLI Select. But now the construction loans specific with CMHC have their own section of premiums, and it's actually higher than what the bases premiums are going to be for the standard and for the market program.
Yeah, so what does this mean to you? I mean, well, previously to these changes, the MLI Select program was extremely advantageous for insurance premium. It costs significantly less if you can get your 100 points, to the point where, taking the standard product, nobody was taking it. Maybe 5-10% of the applications were taking it, and everybody was taking the MLI Select program for the insurance premiums. Now, if you remember, they actually changed the insurance premiums. I think it was last year, and increased them. Before they were even cheaper before. Now the insurance premium increases scale. So for anybody who doesn't know how these CMHC standard or original CMHC premiums work, they scale on a sliding scale. So they scale based off of loan to value. The higher the loan to value the metric, the higher the insurance premium. And they also scale based off of amortization. So for every 25 years on top of your for every 5 years on top of your 25 years of amortization, they then add an additional 25 basis points of insurance premium. So, you're penalized if you're looking for the highest leverage because you have the highest insurance premium, but you have less of an insurance premium if you have lower leverage and lower amortization. And I think there's a handful of variables as to why CMHC did this. There wasn't like an official statement as to why, but I think that the leverage that was out in the market, this is kind of an inadvertent way for them to be able to reduce the leverage or to fundamentally be able to protect themselves in case we do have higher defaults.
Yeah, I think there was a high usage of the MLI Select program, and if you go back a few years when it was first rolled out, for whatever reason I don't think they were really expecting it to be that popular. I think now that they've added the amortization premium on the MLI Select, which it did not have previously, and also just the increases in premiums on the construction specific, I think they're really just trying to spread the volume out over MLI Select and on the standard program. I think the construction, the increase is there. I think it's really just trying to push some people away from doing CMHC construction just by putting that higher premium on there, because if that premium will roll over into your term debt, whereas if you go and build with some sort of alternative non-CMHC financing and then come back in and take your construction takeout financing, you're actually subject to the lower insurance premium. I mean, we've seen a lot of investors start to go that route just because it saves you almost 85 to 90 basis points. So I think it's risk. I mean, I think the head of CMHC was even talking about de-risking their book. Obviously CMHC, the numbers came out and it was 96% of new rental builds were CMHC. It was a pretty high number. I can't remember it exactly, but the statistics are there to prove that CMHC is essentially it's almost all the market for new construction, and I think they don't want the risk, and they're trying to spread it out. So that's what they're trying to do with the insurance policies. I don't think they can do much more to change the actual programs. They've already brought down some of the scoring on energy efficiency. They've changed some of the accessibility stuff like that. So I think the insurance premiums are really only the way to go. There still is some benefit, obviously, of going with the MLI Select program. You do get discounts now on your points. So 50 points gives you a 10%, 70 gives you a 20%, and then the 100 points gets you a 30% discount. So you still can get a cheaper insurance premium overall going with MLI Select. Again, like it's one of those things where sit down, run the numbers, figure out exactly what makes more sense, on the cost of the project, see if they hit that. And then also, looking at overall NOI with having the affordable units. It's just going to be a bit more of a number crunch now and figuring out what makes more sense. But yeah, I think as of what most lenders are, they're not that CMHC is a lender, but their mindset is de-risking, and that's kind of where they're pushing it.
Yeah, and I think that when you're looking at the difference between taking on insurance premium, which is actual debt versus increase, equity, I think that conversation's happening more now. You start to take a look at the drastic impact in the increase in insurance premium on construction lending versus just going uninsured. There is a massive gap between the equity required on an insured construction loan versus standard uninsured financing, but that gap on like a 10 or 15 or 20 million dollar building, you're looking at, I think it's 8 or 9% now almost for the new CMHC construction insurance premium at the highest loan to cost metric. It's creeping up there to the point where it's a significant chunk of insurance premium. What we're seeing and what we probably expect to see moving forward is clients start to look at those alternative options again. Like, does it make sense to take on that additional cost to be able to do this if you can just put a little bit extra capital down, especially if you're raising capital or you're building a smaller project. Equity allows you to be able to create more profit in your deal. Whereas, if you're looking at these insurance premiums, they're so high now at the highest leverage that you might be underwater on your debt. So you're qualifying at 1.1 debt service at the highest level of CMHC, but if you're 95% on cost or LTV and you have a 1.1 debt service with the highest insurance premium, you actually might be cash flow negative. And some lenders, some of the bigger lenders are actually are shying away from any of the leverage at that level. So it's also going to shift to the type of lender or only specific lenders who have an appetite for that type of debt in the market.
Yeah, I think if I remember correctly, like even if you hit all 100 points and your max leverage, like I think even with the premium discount and the premium on top of like the amortization, like you're right around 5% now, which before you were like 2.55%. So the insurance premiums have almost doubled on the MLI Select side. And yeah, if you're at 95% loan to value and you're at a 1.1 debt servicing, you got to remember that 5% in insurance premium is not calculated in that debt servicing. So where before you were squeaking away with like properties that were maybe just breaking even, like I think, yeah, you're going to be pretty close to like that 1% debt servicing on some of these properties, especially more so in Ontario. Just obviously the numbers aren't as competitive as New Brunswick or prairie stuff, Manitoba, Saskatchewan, Alberta, but Ontario for sure. I mean, like obviously, for those who aren't familiar, like when you're getting the cash flow numbers, just make sure that you're factoring in that insurance premium in your mortgage payments and not just taking a look at your 1.1 debt service, because it does not include that.
Yeah, I saw a post, I think it was by Dan, and he was showing about how many new housing starts were happening, and the majority of the new housing starts are all purpose-built rentals. So, all of these projects that are going to be restructured out in the next 12, 18 months, they're all going to be, if you didn't get the COI right away, you're going to be refinancing into these new premiums, and maybe the economics might work, maybe they don't. There's a lot of kind of unknowns right now happening within the industry. Bond yields are staying at least consistently elevated for now. We haven't seen any sort of downward pressure on those, and when you're looking to submit your file, I'm sure, if you guys have a CMHC submission in, that max rate is probably pretty low to be able to get the maximum loan to cost you're looking for your project. So, taking a look at just the different variables that are going on with the product as a whole, it's something to keep in mind when you're closing out your construction financing.
Yeah, I think overall, even with the changes, obviously, CMHC still is the most competitive program product out there for purpose-built stuff. Investors don't really still have a choice if they're looking for that higher leverage. Obviously, if you're borrowing money for your down payment, your construction, your renovations, whatever it is, investors are still looking for max leverage. So, it's more about just staying informed and understanding how the numbers have changed and what that's going to do to your project and the cash flow. But again, like I don't think it's going to change the amount of investors who are actually using the program, maybe on the construction specific standpoints, and that might have its own impact in what we're starting to see on the construction side on the non-insured, just as we get a bit of this movement away, it might make it a bit tougher. You're getting, just more volume on the non-insured side. But just staying informed, and obviously run your projects by your brokers just to make sure you understand exactly what your cash flow is going to look like.
Yeah, and this is our monthly CMHC update, guys. If you guys did like this video and you thought it was informative, we would really appreciate if you hit the like button, hit the subscribe button. It allows us to do this, to create more content for you. But before we actually end the video, Aaron and I have a podcast, and if you haven't listened to it, you can listen to it on Spotify, you can listen to it on Apple Music. Essentially what we do is we sit down with industry professionals and talk about what they're doing, what they're seeing, capital structure. It's a little bit more in-depth. It's more of a free-flowing conversation between Aaron, myself, and this person, and we're trying to give you guys a little bit more insight into the market and what's happening in real time. So if you did like this video, go check out that stuff. We're going to continue to create more content for you and hope you guys love it.
Banks have an insurable risk in your property. They want to make sure, for one, if it burns down, that they're going to get their money back.
We are graced today with Mr. Samuel Castillo. Sam is an insurance wizard. Sam specializes in helping investors, developers in navigating the complex world of insurance.
A lot of insurance agents or brokers, they don't understand exactly what the bank needs. Simple as that.
What are some challenges or some mistakes that you're seeing investors make when they're getting this insurance?
Some insurance companies, a lot of insurance companies, especially with older buildings, and we're seeing a lot of people buy older buildings. Maybe it was a manufacturing plant or a school. They're now converting it. And you know how big of a pain it is to even get the banks to accept it? Mm-hmm. Think about an insurance company with an older building with old plumbing and all that kind of stuff. They're not going to want to offer a replacement cost, give you a brand new building when it was a 1920 building, right?